Friends, something happened in the business world this week that is effectively rewriting the DNA of the insurance industry. Lemonade, the insurance tech disruptor, teamed up with Tesla to drop a bombshell. If a driver flips on FSD, their insurance premium gets slashed by 50%. This isn't some marketing gimmick or a seasonal sale. This is cold, hard mathematical logic. It marks the moment human drivers were officially dumped by the capital markets as high-risk assets. More importantly, it shows that the legendary moat Warren Buffett has guarded for 50 years at GEICO has turned into a defenseless marginal line in the face of Musk's data supremacy. Why do I say this discount is a killer? Let's look at the bedrock of the business model. For the last 5 decades, Buffett turned GEICO into Berkshire's ultimate cash cow. He didn't do it through magic. He did it through a massive actuarial system based on the law of large numbers. GEICO's profit formula is simple: premiums in, minus claims out, minus operating costs, plus investment returns on the float, to control those claim costs. Traditional insurers hire thousands of actuaries. These people look at your age, your gender, your zip code, and your credit score to guess your risk. And I want to emphasize that word guess. It's basically a blind box game because GEICO has no clue if you're going to run a red light in the next 10 seconds. They can only tell you that, statistically, a 25-year-old single guy in a city is more likely to crash than a 50-year-old married woman. Because of this information asymmetry, good drivers are forced to pay high premiums to subsidize the accidents of bad drivers. That's how the old guard makes its excess profit. But Musk just flipped the table. When Lemonade can tap into Tesla's API and read 7 billion miles of driving data every millisecond, the game shifts from probability to physics. Tesla doesn't need to guess. They know if your eyes are on the road. They know if your braking force is 0.3 grams or 0.8 grams. They know if you slow down in a rainstorm. Most importantly, they have a statistical conclusion that makes traditional insurers feel sick. FSD's accident rate is only half that of a human driver, if not lower. This creates a massive safety arbitrage gap. Lemonade isn't burning cash for growth with that 50% discount. They're doing it because they can calculate risk better than anyone else. Even at half the price, if you remove the human driver, the biggest source of risk, their profit margins still crush GEICO. For the old insurance titans, this is a gray rhino crisis. If this were just a price war, Buffett with his $100 billion cash pile could outspend Musk until the end of time. But the dimension of the problem has changed. This is a data-driven dimensionality reduction strike. Just walk through the logic of where the money goes next. The high-quality customers, the ones with the best driving habits, the ones who embrace AI, the ones who care about safety, are going to realize very quickly. Why am I paying $3,000 a year to GEICO to subsidize the idiots on the road? They'll jump to Lemonade and Tesla insurance without a second thought. This triggers the industry's ultimate nightmare: adverse selection. When the good drivers leave, what's left in GEICO's pool? The gas car laggards, the AI skeptics, and the high-risk drivers Tesla wouldn't touch. GEICO's risk concentration will skyrocket. To cover the soaring claims, GEICO will be forced to raise prices, and as soon as they raise prices, the middle-tier customers will find them too expensive and leave too. This is the script we hate to see in the secondary market, the death spiral. So, the conclusion from Iron Bull Finance today is very direct. Stop trying to value traditional insurance stocks based on P/E or P/E ratios. When FSD turns driving risk from uncontrollable human nature into controllable code, the moat is no longer the brand, the sales network, or even the float. The moat is the ownership of real-time data. Now, I know some of you might be skeptical. Why would GEICO, with its century of history and mountains of data, be as helpless as a blind fly against Musk's algorithm? The answer is hidden into words: granularity and blind spots. Think about the GEICO money-making machine. In the Wall Street narrative, this is peak wisdom. But if you peel back the complex math, the model is prehistoric. When you apply for a policy at GEICO, what do they ask? Age, gender, zip code, marital status, credit score. Notice the trend. All that data is about who you are, not how you drive. In the old world, GEICO says, statistically, a 25-year-old in Chicago is 3 times more likely to crash than a 50-year-old in the suburbs. So, even if that 25-year-old is a professional race car driver who drives like a saint, he pays triple. This is the socialization of risk. Because GEICO is blind to the actual driving process, they have to shove people into crude risk buckets. They punish the majority of good drivers too. Cover the risk of a few bad ones. This is the ultimate pricing incompetence, and in 2026, it's a massive arbitrage loophole. Tesla and Lemonade operate in a different reality. When Musk says FSD improves safety, he's relying on physics, not probability. Tesla doesn't care if you're a man or a woman or how many times you've been divorced. They care about the millisecond level data coming back from the sensors right now. They don't need a clunky OBD box plugged into your car. Lemonade reads the telemetry data straight from the Tesla's motherboard via API. It shows whether your lateral g-force in a turn is 0.3 or 0.8. It shows if your reaction time when the car in front brakes is 500 milliseconds or 2 seconds. It knows exactly how many times per minute your eyes drift from the road to your phone. They aren't guessing if you have risk. They are watching you create it. In this dimension, a 25-year-old with perfect habits is a low-risk asset. Lemonade gives him 50% off because the data says his chance of a claim is near zero. When FSD takes over, this advantage reaches its peak. Investors, please understand this. When a driver enables FSD, there is a transfer of risk liability. The driver is no longer a tired, emotional, distracted human. It's a tireless silicon-based AI with 360-degree perception. To an insurance company, humans are an uncontrollable variable. FSD is a controllable constant. A human might run a yellow light because they're in a bad mood, but FSD always follows the logic of the code. That 50% discount is essentially the premium Lemonade is willing to pay to eliminate human nature from the equation. You might ask, Buffett is rich and smart. Why can't he just copy this? Why can't GEICO just build an app to read the data? This is where we get into the most hardcore investment logic of this episode, the curse of technical debt. I've looked through Berkshire's shareholder meeting records, and Buffett's insurance lieutenant, Hijack, admitted something staggering. GEICO has over 600 independent, siloed legacy systems. What does that mean? It means GEICO's IT architecture is like a crumbling building held together by countless patches. These systems were written decades ago in ancient programming languages. They can barely talk to each other, let alone interface with Tesla's API streams which push millions of data points per second. While Lemonade's engineers are training AI models with code, GEICO's actuaries are likely still merging Excel spreadsheets. This isn't a money problem, it's a DNA problem. To play Tesla's game, GEICO would have to tear down 50 years of infrastructure and pricing philosophy. The entire financial world is undergoing a systematic reboot. When vague risks are precisely quantified by code, the old profit-sharing structures will fall like dominoes. This structural wealth transfer is often hidden from view. To help you see the cash flows moving behind the scenes, Iron Bull Finance has put together an FSD billion-dollar dividend manual to help you understand the logic of this dimensional gap. I've linked it in the comments below for you to grab. For GEICO and Buffett, the nightmare isn't a falling stock price. It is that their massive pool of customers which used to generate endless float is being poisoned through an irreversible process. Let's do the cold math that no car owner can refuse. In the past, FSD was a $99 a month high-tech toy luxury you bought to feel the future. But the moment that 50% insurance discount was announced, FSD's DNA changed. It became a financial tool that makes you money. Data doesn't lie. Let us do the math. The average monthly insurance for a Tesla in the US is about $250. Lemonade promises a 50% cut if you use FSD. That's $125 saved every month. Now, you pay Tesla $99 for the FSD subscription. $125 in savings minus the $99 cost equals a $26 net profit. Think about that. You aren't just getting the world's most advanced AI driving system for free to handle traffic and long commutes. You are actually making enough for a few cups of coffee every month. This is premium arbitrage. All the hesitation about FSD being too expensive vanishes. Because the logic is no longer should I pay for tech, but am I losing money by not subscribing? This psychological mechanism loss aversion will drive FSD penetration from 15% to 80% or higher. Where is this money coming from? This is the ultimate wealth transfer. For 100 years, the thousands of dollars we paid to GEICO or Progressive were basically regret insurance. Because humans are unreliable, we assume we will crash. So that money is a pool for post-accident compensation. In Musk's logic, that money is intercepted. When algorithms cut accident rates by 50% or 90%, society doesn't need to buy that much regret anymore. The massive cash flow that used to belong to insurance companies is being rerouted. $99 goes to Tesla as high-margin recurring revenue to fuel more R&D. And the remaining $26 stays in the consumer's pocket as a tech dividend. This is the final form of dimensionality reduction. Tech companies aren't just earning a premium, they are eating the cake of the traditional financial sector. They are turning money for mistakes into money to prevent mistakes, for an incumbent like GEICO. This is a physical extraction of their industry's foundation, but Musk isn't just doing this to sell FSD subscriptions. There is a Trojan horse hidden behind this Lemonade partnership, and it leads to a $1 trillion valuation. Robotaxi. Think about it. What's the biggest hurdle for robotaxis? Is it tech? Computing power? No, it's trust. It's the fear regulators and the public have toward autonomous driving. Insurance companies are the most risk-averse, calculating institutions on the planet. When a company like Lemonade is willing to back FSD's safety with a 50% discount in actual cash, they are handing Musk the most powerful letter of intent for regulators. They are telling the world, look, even the people most afraid of losing money are betting that I won't crash. What are you still worried about? Tesla is playing a massive game of chess. By using insurance arbitrage to induce millions of owners to turn on FSD, those owners are essentially paying Tesla to perform a shadow test of Robotaxi at an unprecedented scale. Every mile driven by FSD feeds the Dojo supercomputer, paving the way for the cybercab. This leads to our endgame in the next 3 to 5 years. As FSD data accumulates and insurance discounts grow, driving yourself will no longer be a right, it will be an expensive privilege. It's like riding a horse to work today. You can do it, but you'll pay a fortune in insurance because a horse is a risk to public transit. In the future, when you check the manual driving box on your insurance form, your premium might double because, in a world of algorithmic roads, an emotional, tired, slow-reacting human is the biggest risk factor. Finally, let's talk investment. In this shift from premium arbitrage to algorithmic supremacy, where should you stand? The strategy is clear. Don't be a landlord for the old era. The traditional insurance giants relying on fortune-telling pricing models have moats that are drying up, leaving behind nothing but toxic assets filled with high-risk drivers. Look to the gatekeepers of the new world, companies that hold the real-time data and the entry points to the physical world. This isn't just Tesla. It includes fintech companies like Lemonade that can rebuild pricing models through data integration. Friends, don't try to pick up coins in front of a steamroller. When data becomes the new oil and algorithms take the wheel, the financial logic of the old world collapses. You can either hold onto the actuarial tables of the past as they sink, or you can board the new financial vessel driven by code. The choice is yours. Market puzzles are always missing that one piece, and it's usually found in the places the news doesn't mention. This is Iron Bull Finance. See the pattern before the crash.